Good morning, everyone. Welcome to Daily Rates Live with the Mortgage Calculator. Today, we're going to be looking at our live mortgage rates for some different programs, and then we're going to be talking about home equity lines of credit. So, give us just a minute here to get started. I see some comments coming in there already. Appreciate it. We got the chat up on the screen. Go ahead and drop a comment there as you tune in, and we'll get started here in just a moment. Great topic today. Yesterday, we talked about HELOANs, and today, we're going to be talking about HELOCs. So it looks like we're live on all the platforms. We'll go ahead and get it started here. What we'll do is we'll take the chat off the screen for now, but go ahead and keep dropping comments there in the chat. And you can also drop any questions that you have in the chat, and we'd be more than happy to answer them after we go through our deep dive topic here for today. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our CSO, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every weekday at 11 a.m. Eastern on this show is go through our actual live mortgage rates, and then we do a deep dive into a different loan type. And today we're going to be talking about HELOCs, home equity lines of credit. Yesterday we talked about HELOANs or second mortgages. Today we're talking about HELOCs. So we will get into that here shortly, but first, let's go ahead and see what the rates are today. So, Nick, if you're ready, let's go ahead and pull up the rates for today and check them out.
All right. So for today, not much change, but we will check out the rates. It is August 20th, just after 11 a.m. All the initial rate sheets for the standard programs are live here. We will compare the APR across the programs. If you'd like a full breakdown and itemized loan estimate, please get one of our loan officers. They'd be happy to help you out. For the demo, we'll use a standard scenario, single family home. We use a $500,000 purchase, $400,000 loan amount. That corresponds to 20% down payment, 80% loan to value. And we'll use an estimated 760 FICO credit score and an estimated 40% debt to income ratio for all these demos here. So let me go ahead and share my screen and I'll get into the live rates for today. So again, not much change from yesterday. First up here, our 30-year fixed conventional option, typically the most common option people think of when they think of a mortgage for a primary home. Rates as low as 6 today. I was hoping we could get a little bit below 6. Final APR 6.324 to compare all the fees across the programs. Now, if for any reason our customer doesn't qualify for a conventional option, we'll typically want to present an FHA option, which allows more leniency on credit issues, as well as a much higher debt to income ratio overall. But it does require upfront and yearly mortgage insurance. FHA comes in at 5.25 rate, and the APR with all of the fees and mortgage insurance, 6.169. So if our customer qualifies for both, they may want to consider FHA. It's a touch cheaper, but does require that yearly mortgage insurance. And our customer that needs to use it, definitely a great option. Moving on to our VA options, only for eligible vets and active service members. These programs are amazing. Rates as low as 5.375 for those that are eligible. Final APR with standard funding fee here, 5.682. And notice we're comparing that across the options. VA is always going to be the best option for our VA eligible borrowers, as the APR is much lower than any of the other programs here. Now moving on to our final standard option here, final government option, USDA, is only for properties in USDA areas. Those are the rural areas of the country. The property is eligible and our borrower is eligible. These are good options to consider. Rates today coming in at 5.25, final APR 5.996 with standard fees here. And when we're comparing that to FHA, USDA is a touch cheaper as usual, and obviously a touch cheaper than conventional as well. So for those looking in those areas, definitely a good option. And those first 4 options are the standard options any bank or lender has. But if our customer doesn't qualify, many banks or lenders have to deny them. That's where we love to present our alternative options. First up, non-QM alt doc for a primary home. So customer doesn't qualify for conventional using tax returns, full doc, regular documentation. We can switch to alternative docs such as bank statements, 1099s, P&Ls, etc. And rates today coming at 6.625, final APR 6.939. So we're within about 0.6, usually within about 0.5 to switch to alt docs. So great option for our customers that need to use it, and it's not very much more expensive there. So great option. And tons of flexibility once we get into investment properties. So first up for investments, our alt doc option here. Again, bank statement are similar. For investors, coming in at 6.999, final APR 7.429 to use alt docs on an investment. And we'll compare that to our other investment options. First up, conventional. We don't have government programs, so no USDA, FHA, or VA, but we do have our conventional option coming in today at 6.75 for an investment property. Final APR 7.095, coming in quite a bit lower than alt-doc, which is great. More standard scenario there. But we always recommend our customers check out our favorite options, our DSCR, our flagship program here. No income needed, no employment needed. DSCR stands for debt service coverage ratio. We just use the estimated rents from the appraisal to compare that to the estimated expenses. If the property will cash flow monthly, that's a ratio of 1 or higher, which is preferred. For all the demos, we set the ratio at 1.5 so we can see all the programs. First up, our 3-year prepayment penalties, standard option for a DSCR loan, coming in today at 6.625, final APR at 6.951. And our 5-year prepayment option coming in at 6.5 rate, final APR 6.810. So just a touch cheaper there to add the 5-year prepay. And our final DSCR option, no prepayment penalty. These are available for the states that don't allow it or the customers that don't want one. Rates as low as 7.125, final APR 7.466. So it's a touch more expensive than conventional, but I'd still say 100% of investors would choose a DSCR when we're within just a tad bit more on the cost there. And our final 2 demos we did yesterday, a deep dive into this. These are our fixed rate second mortgages, which you'll see are different than our HELOCs, which Jose is going to go over in a minute. So these are fixed rate second mortgages that use alternative docs for a primary home to get cash out without touching that first mortgage. So many customers want to get cash out. Their only option typically is a HELOC. And we'll go over that today. But these fixed rate second mortgages do have lower rates. So great options to get cash out of that primary home. Rates as low as 8.5, final APR 8.930. And these are fixed and non-QM, so we can use bank statements and similar. And again, same thing for investment properties, that fixed rate second mortgage to get that cash out. And HELOCs are rare for investments. Hopefully Jose has an option, but you'll see that they're a little bit more rare. For second mortgage for investment, rates as low as 10 flat, final APR 10.221. And just remember those numbers as we will compare that to our topic for today, which is going to be our variable rate HELOCs, which is the more traditional option people think of when they're trying to get cash out or a line of credit on their home and don't want to touch their first mortgage. So these are great flexible options, but they're different than what we talked about yesterday and what we just went over in the fixed rate second option. So Jose, if you're ready, let's check out some of today's rates for the HELOCs. And hopefully we see those rates come down here soon, but not quite yet. Are you frozen, Jose? You there?
Good morning, everybody. Thank you for joining us for Daily Mortgage Rates Live with the Mortgage Calculator. Today, we're going over our HELOCs. Now, what is the difference between a HELOC and a HELOAN? Well, the very important difference is that the HELOC is an open-ended loan, meaning that it does not have a fixed amortization table. You pay interest on the balance that you owe. So that's a great option for people that are going to have short-term use of the money. And most importantly, for borrowers that are able to pay down the balance, because the big advantage of the HELOC, which is also its disadvantage, is that you pay interest on what you owe, right? So as you bring the balance down, then your interest expense is going to drop. Conversely, please be aware that all HELOCs have a draw period, which is the period during which also you can make interest-only payments. Once that draw period expires, then the loan converts to a fully amortizing loan, and the term is going to depend on how long of a draw period you had. For example, if the draw period was 3 years, then the loan, which is very popular draw period now, the loan will then convert to a 27-year fully amortizing loan. So the payment will go up. So just be aware when the HELOCs are getting set up. so that you know how to consult your borrower on choosing the 3-year draw or the more common, or was the more common choice, 10-year draw. Many uses for the HELOC, which I'm going to illustrate right now. Let me get into the first option. First option now is for a standalone HELOC, a cash out on a primary residence at the maximum 90% LTV. We have had some retrenchment in this space, whereas before we were able to readily find 95% CLTV options. We are now at a 90% combined loan to value between the first mortgage and the HELOC. So the scenario here, we have our HELOC of $201,000, and we're looking at a rate of 10.5%, and this is with our maximum credit score borrower as well. Now, for our borrower with lower credit, here is our lowest credit score option HELOC. 640 credit score is the minimum credit score. 70% CLTV is the maximum CLTV. And again, this is for a primary, and we are looking at 12.875 for our $160,000 HELOC. And now this is investment property HELOC. This is 80% CLTV on this one, right? Which is the maximum CLTV on the investment property. This is full doc as well. And we're looking at 10.125 as the interest rate for this 80% CLTV HELOC on an investment property. And a couple of additional uses outside the box. This is one of our favorite uses for the HELOC. This is our condo purchase when we need a limited review condo purchase. Now, this is, again, very popular in Florida because Florida is treated differently than the other 49 states regarding condos. The other 49 states, if you have a limited review condo, meaning that the condo does not have enough reserves or may have other financial issues, and the only way not to delve into those issues is not to have it as a requirement on the condo review. So the limited review option does not ask to review a copy of the budget. So you will not need to worry about reserves. However, just note that in Florida, it's 75% max LTV on the first for this option, whereas the rest of the United States is 90% LTV, the limited review first mortgage. Hence, in Florida, what we do is we get that 75% first mortgage, 75% LTV first mortgage, combine it with a 15% LTV HELOC to attain 90% CLTV. Right, so you will have loan level price adjustments on the first due to using a HELOC combo, but again, you're saving a big amount in the down payment. In this scenario here, our borrower is saving $90,000 in down payment. So 7.375 is our lowest cost option at par, and you can buy that down to 6.125. Another common use for the HELOC, and I didn't mention that's also an additional benefit of the option I just showed you, is that when the LTV on the first mortgage is 80% or less, there is no need for mortgage insurance. So here we have our 80% LTV first mortgage, And we have a HELOC for 10% LTV for a 90% CLTV option. We used to be able to do this up to 95% CLTV option, but no longer possible. And our lowest cost option is 7.625 at a cost of a quarter point. And you can buy that down to 6.5% at a cost of 2.375. And our last option here is we like to call this our jumbo substitute option, right? This is the option that allows you to buy the what normally would have to be purchased with a jumbo loan with a conventional loan, so you can benefit from the conventional loan guidelines and the conventional loan underwriting, automated underwriting. Um, we used to be able to take this again to 95% CLTV, but now we are at 90% CLTV for this option. So in this scenario, we're purchasing borrowers purchasing $1 million property. They are financing it with a first mortgage of $720,000, a HELOC of $180,000. So the rate 7.625 is our lowest cost option, costing a quarter point. You can buy that down to 6.5%, costing 2.375 points. And our HELOC down here at 13.5%, $180,000. And the main goal there would be for the borrower to do an accelerated repayment plan to hopefully pay that HELOC down quicker and end up just with the first loan. So many options here for your HELOCs, other than just your traditional using it as an additional means to access funds. The most popular use, of course, especially in Florida, is the limited review HELOC combo purchase, which is the one that still maintains its maximum advantage, as it was always maximum 90% CLTV. Fannie Mae guidelines for the second mortgage on that product.
Okay, I don't see any questions on HELOCs, but there is a question that we'll go ahead and take. It looks like there's one question here, which is, do we offer mobile home loans? If yes, what's the rate? You want to touch on that, Jose, because there's some confusion around that sometimes.
Yes, get that question all the time. Most of the time when the borrower is referring to mobile homes, they're actually referring to a manufactured home. Now, make sure that when you're reaching out for structure assistance with this type of property, that you request the assistance for the correct type of property. It's a manufactured home. If it sits permanently attached to a piece of land, and if you can search it in public records and by the address, and you will pull it up and it will say it's a manufactured home, and it'll say the lot size, a folio number, and all that good stuff, then you know you're good with a manufactured home. All manufactured homes start life as a mobile home. They have a vehicle title, but it isn't until they are permanently attached to the land and an affidavit of a fixture is provided as confirmation that it has transitioned from being a mobile home to a manufactured home and now is actual real estate. So real critical component there to consider. And something else very important to consider with manufactured homes is you can only finance them if they are permanently affixed to the location where they were originally installed. So if that manufactured home has been moved from the parcel where it was originally installed, then we cannot finance it with any of our agency or non-QM products that we have. There may be some obscure lender out there lending to manufactured homes as a mobile home, which would be the option then that you would get, like when people buying a mobile home to place in a mobile home park where they pay lot rent, right? That's similar to financing a car, but it would not be real estate financing like through an FHA loan, for example, which tends to be FHA, USDA, and VA tend to be the best options for manufactured homes.
All right, another question: minimum credit score for residential properties.
Well, that's a pretty broad question. So let's break it down into um, agency loans and non-QM loans, right? So we'll go with the easier answer first. Non-QM loans, look at the guidelines because non-QM loans are always manually underwritten, right? So whatever it says in the guidelines or in the credit matrix for that particular option, and again, you got to look at all the options because non-QM guidelines are not homogeneous. They are specific to whatever investor the loan is going to be sold to. Now, agency is not as straightforward of an answer because in agency, it's going to depend on, are you dealing with a manually underwritten file or are you dealing with an automated underwriting file through LP or DU, which are the two channels for automated underwriting. If you're dealing with manual underwriting, you got to go to the matrix, which is published for whichever agency loan that you're dealing with, and see what is the maximum DTI and minimum credit score and all that kind of stuff that's important for the agency loan. If it's automated underwriting, is going to, which is usually the answer usually the option unless there's something wrong with your loan, like disputed accounts, for example. So if it's automated underwriting, it's whatever automated underwriting gives you as a findings. So for example, last night I ran one FHA and it approved it at a 46.3% front end ratio and 57.2% back end ratio because automated underwriting looks at the merits of the file, the compensating factors like LTV, credit score, reserves, and then will give you the approval. So it would be theoretically possible for you to get an approval, automated underwriting approval on an agency loan, conventional, let's use this example, where you may be under 620. But hopefully that's going to be a deal that does not require mortgage insurance because you will not be able to obtain mortgage insurance. Or even if you could, or theoretically, if you could shop for it, you may get a rate with such a low score that's out of scope and no premium will be provided because it's just too expensive to provide, which then you would probably have to go FHA.
All right, looks like we got one more question here. What's the average prepayment penalty fees associated with deal?
All right, cool. I mean, we're getting some general questions here. Again, now going back to how it works out with guidelines and non-QM. There is no set across the board answer. It is all depending on what what combination of cost and rate the borrower desires, right? DSCR loans are investment properties only. Investment properties, you are allowed to usually always put a prepayment penalty unless it may be a no prepay state based on loan amount, or unless that particular investor who we're selling the loan to doesn't allow prepayment penalties. With that being said, prepayment penalties, if one is chosen, can range anywhere from 1 to 5 years and can be either a declining prepay, meaning, for example, if it's a 5-year prepay, it'll be 5% first year and then 4, 3, 2, 1 declining for each year. Or it can be a straight prepay of, for example, 5% all 5 years or 5% 3 years. Obviously, the more restrictive the prepay or the higher the prepayment penalty associated with it, the higher the credit that the borrower is going to receive for having that type of prepay on the loan, which would result in a lower upfront cost to the borrower. So definitely you got to give the borrower those upfront costs because usually they're not going to sell or refi and they're going to benefit from the lower payment and lower cost and lower rate now.
All right, we'll take one last question because it is pertaining to HELOCs, which was the topic for today. So on a HELOC, how fast can the first draw? I guess how fast do you draw?
Great question, because the important thing to consider on HELOCs and on these HELOANs, but on HELOCs specifically, is that you want to make sure, because the HELOC is the one that lets you pick the draw, the amount that you want to draw at closing, since it is a variable amortization, it's not a fixed amortization loan. It is recommended that if the borrower needs access to those funds right after closing, that the distribution occurs at closing, because usually after closing, there is a period of anywhere from 60 to 90 days while the account is being set up, that an additional draw or draws period can be obtained. So typically, if you close today, get the money today, because they're not going to let you draw any money additional from the HELOC for usually 2 to 3 months after it closes.
All right. Great questions here today. Thank you for that. We'll go ahead and wrap it up, though. Remember that we do this at 11 a.m. Eastern every weekday, where we go through the live rates for that day. And then we do a deep dive into a different loan topic. So we will see you all tomorrow at